Good morning, Kyle. This is Merlin. I'm just testing if you can hear me.
Merlin, I can hear you. Can you hear me?
Perfect, Kyle.
Cool.
All the delegates attending, can you just give us a heads up if you can hear Kyle, please? Thank you.
Yes, please. And also the screen. Can the screen that I'm sharing be properly seen?
Yes, Kyle, we can see the screen, but if you can just minimize all the delegates' names, there's a black screen in front of it. If you can just minimize that for us.
Is that better?
Perfect. Thank you, Kyle.
Good stuff. Thank you. Ladies and gents, we'll be starting in another 3 minutes. I see it's now just before 11 o'clock.
Maybe it should be making out. Now, and we have page full locally. So, when people want to speak to someone on the way, I just want to try to very quickly and say within another 2 or 3 minutes before we start, give people time to log on.
Okay, cool. All right, I don't know. I'll do that quickly.
Thanks,
Morning, ladies and gentlemen. I've just been notified that a lot of us are dealing with some stage 4 load shedding. So I've just been advised to just give it another couple minutes before we get going. You know, I see it is now 2 minutes past 11. Apparently, a lot of people are still busy logging on. So I think we'll start at 5 past 11. So we'll just give it another 3 minutes just to give everyone a chance to log on. Thanks, everyone. All right, everyone. I think we have now given everyone sort of enough time to get online, and I think we can proceed with the seminar as such. Now, ladies and gentlemen, last week we had a look at sort of the processes or the steps involved in winding up a deceased estate, and then we started speaking about the liquidation and distribution account, and we actually spoke in essence that it consists of a number of accounts, and the accounts we wanted to speak about was the liquidation account, the distribution account, the estate duty account, the income and expenditure account, as well as the recapitulation account. And we sort of had a discussion about the purpose of each account and what we're trying to achieve with each account. Now, what we want to do today is we want to start having a look, or we want to spend today and tomorrow sort of having a look at this L&D account, looking at how the different accounts look. And I've sort of drafted, sort of an easier version of how to go about thinking and drafting this L&D account and how it would look. And I think it will come of assistance. So on everyone's screens, my terrible handwriting should be displayed, and we should all be seeing tips with the liquidation accounts. Now, ladies and gentlemen, I believe I mentioned last week, obviously your liquidation account is your longest account, and your estate duty account is probably your toughest. The other accounts is a heck of a lot easier and will take us quick to go through. But today I want to spend, a lot of the seminar discussing the liquidation account, and we'll see if we have time. We might start with the estate duty account today as well, depending how things go. So on this very first page you have open in front of you, you'll note I haven't started the liquidation account. I've just sort of given tips on how you go about drafting the liquidation account. And ladies and gentlemen, perhaps I say a couple of things now that you're not quite too sure of, and maybe doesn't quite make 100% sense for you. But I would request that you take your notes as we go along, because as we go further into the liquidation account, perhaps I maybe answer your questions, or perhaps it becomes more clear. Especially if you haven't drafted this before, it does take a bit of time perhaps to catch it. But yeah, we're going to try and make things as easy as possible. And obviously at the end of the session, if you still don't understand something, then please feel free to ask your question so that I can answer it. So let's have a look here. These first 3 dashes that I have with tips of the liquidation account. Now, specifically, I'm speaking about the liquidation account. If we recall, this account, we had to do a sum. Our sum was we had to add up our total assets. From there, we had to minus our total liabilities. We had to minus estate duty, which was possibly money we owed SARS. And then what is left was our balance available for distribution. In other words, that answer that we have left at the end of our liquidation account is what is available to distribute amongst your marriage, your legatees, and your heirs. In terms of your marriage regime, or in terms of what the will said, and if you had no will, obviously in terms of what intestate law dictates to us at the end of the day. So we are just trying to learn how to draft this liquidation account at this stage. And it's the assets that tend to be the problem, because there's certain ways we go about describing these assets, which I'll illustrate to you. But I think these points, if we can just make note of it for now, it's going to help us make sense about how we go about just drafting this liquidation account, especially the assets. So over here I said, if you can see the asset, in other words, if it has not been sold for cash and it is not cash, then it is awarded. If an asset is sold for cash, then it is realized. If an asset is already cash, then it is collected. Okay, so let me explain this point. I'm dealing now specifically with the assets in the liquidation account. Every asset that you indicate the deceased person has, you have to describe. All right, we'll have a look at examples about how we describe assets. But then you've got to make a decision. Is this asset cash or is it not cash? If it is a non-cash asset, ladies and gentlemen, what's typical as an example about this? If you pass away and you have a house, if you have a car, if you have furniture, all those assets are worth something, they're valued. But it is not cash. All we can do is value those assets and say what they are worth. But we cannot say it's 100,000 Rand, because we don't have 100,000 Rand. We might have a car that's valued at 100,000 Rand. But the fact that it's not 100,000 Rand cash means it's a non-cash asset. And in point 1, you can see, if the asset is not cash, then we use the word awarded. Now, ladies and gentlemen, I want us to think practically about this. If we say we have a car and it's valued at 100,000 Rand, the question is going to be asked, how do you know? What proof do you have that this car is worth 100,000 Rand? So every asset that is not cash, what we do is when we are done describing it, we need to say who valued that asset. That just makes sense. How did you come to that 100,000 Rand for that car? Who valued it? What company was able to provide you with a valuation towards that car? And then when we are done describing it and saying who valued it, we need to award it. We need to give that asset away. Now, ladies and gentlemen, how do we award assets? Well, that depends on the marriage regime, and it depends on what the will says, or it possibly depends on what intestate law says. If you were married in community of property, and you had a will and you said your two kids, A and B, must get everything. So we know A and B are your heirs. But we also know you were married in COP, meaning half of everything is your surviving spouses. So if I had to award that house or that car, I would look at marriage regime. Okay, there was a marriage in community of property. So half of it I'd need to award to my spouse. The other half, I'd look at the will. And the will said, for example, okay, your two heirs are A and B. I would then award the other half to my heirs. So you've got to look at, when deciding how to award an asset, it depends always on marriage, and it depends what the will says, who must get what. And if there's no will, you'll have to do your intestate law calculations to see who's entitled to inherit. And obviously, ladies and gentlemen, if there's no marriage, or if there's a marriage out of community of property, we need to understand that that marriage has no bearing on our assets then. Then we'll just have to look strictly at the will or strictly at intestate law. Okay? But that depends on each scenario. What I want you to grasp for now is that if you have a non-cash asset, when you're done describing it, value it, and then award it. Give it away in terms of what the will says or what intestate law says. If you look at the next concept, if an asset is sold for cash, then it is realized. Now, ladies and gentlemen, if I tell you you have a car valued at 100,000 Rand, but when you passed away, the executor went and sold that car for 80,000 Rand or for 150,000 Rand, it doesn't matter. Are we able to say we have a car valued at 100,000 Rand? Technically speaking, we'd be lying, because even though we had a car valued at 100,000 Rand, we then went and sold it and we got 150 for it or 80,000 for it. So if we say the car is valued at 100K, we are misleading people, because we can't say we have a 100,000 Rand asset if we sold it for 150,000 Rand or if we sold it for 80,000 Rand. In other words, if in the deceased estate are sold for cash, you always use the sold for price. We call sold for, we call it realized in L&D accounts. Always use the sold for price, because that realized or sold for price is the true reflection of what you actually got for that asset. So if I told you had a car valued at 100,000 Rand but sold for 150,000 Rand, when we speak about that car as an asset in our liquidation account, we can't put 100,000 Rand next to it. We've got to put 150,000 Rand next to it, because we always use the sold for figure. Now, ladies and gentlemen, once I've described that car, it makes absolutely no sense to value it, to say who valued the car, because it's cash. We have sold it for cash. So the moment it is cash, we don't need award it anymore. We never award cash. The reason being is we don't want to give any cash away, because we want to keep our cash to, at the end of the day, see that we have enough cash to pay all those people who need to be paid in cash. If you recall our discussion on the recapitulation account, that account we had to determine if we had enough cash. So in our liquidation account, everything that is cash, we do not award at all, because we want to keep it to see at a later stage if we have enough cash to pay those who are supposed to be paid in cash. So if the scenario is an asset that was sold for cash, once you're done describing that asset, you'll just say realized. You don't need to value it, because it is money. By saying realized, you are telling everyone that you sold the asset for cash. Right? Like I said earlier, this will make more and more sense as we go along. And the third important point, if the asset is already cash, then it is collected. All right. So when are scenarios of cash assets where you didn't have to sell anything? I mean, if you take over as executor of a deceased estate and there is 100,000 Rand sitting in the ABSA bank account, I mean, 100,000 Rand is 100,000 Rand. That is cash. In such a scenario, I didn't have to sell anything to get that cash. That cash was already there. So it can't be realized. It is collected. If a policy pays out into the deceased estate, did you have to sell any asset for cash, or did that policy just pay out? That policy just paid out. We didn't have to sell anything. Again, if something is cash, but I didn't have to sell anything to get that cash, we use the word collected. It's money that is already there. We didn't have to sell anything for it. So again, the moment it is cash, ladies and gentlemen, 100,000 Rand is 100,000 Rand. We cannot value 100,000 Rand. So once you're done describing that asset, you'll simply just say collected. So these are the three things we need to differentiate between when drafting our assets or our liquidation account. Look at the asset. If it is not cash, when you're done describing it, you'll need to value it and give it away. You award it. And that will depend solely on what the will says or what interstate law says. If that asset, if you sold that asset for cash, when you're done describing it, you just say realized, and you always use the sold for price. If that asset was already cash when you took over as executor, in other words, money in the bank account is a prime example. When you're done describing it, you simply just say collect it. Okay, we'll illustrate this now as we go along. Two other points I've raised here. When the question says, now ladies and gentlemen, I'm using the term when the question says, but obviously, I mean, let the actual real life circumstances dictate this. When the question says that an asset is worth X amount, but that the asset was sold for X amount, always use the sold for realized price. Okay, this I explained to you over here. Ladies and gentlemen, if you sell an asset for cash, forget about what that asset was valued at. We are using the sold for the realized price because that is the true reflection of what money you got for that asset, right? I think I explained this point over here already, right? The next one's interesting. When the question says that you have X amount in the bank upon date of death, and then goes on to say that after date of death, the amount in the bank changes, then the date of death value is for the liquidation account, and the difference that accumulated after date of death is for the income and expenditure account. So let me explain this. If you recall from last week's seminar, we said we have an income and expenditure account, and that represents all money that we made or all money that we lost after date of death. Because the liquidation account deals with the asset and liability value of the deceased as per date of death. Now let's make sense of this. If you come across a scenario and the deceased person had 5,000 Rand in his or her bank account, the day they died, let's say they died on 6 March, but today, 28 June, you are finally only closing down that deceased person's bank account, right? You know, you had to obviously get your letter of executorship first, and whatever the case happened, you only got instruction a bit late, but let's say today you close down that bank account. Now, on 6 February, when that person passed away, you have a look at the bank statements and you see there was 5,000 Rand in this bank account. So we know at date of death, this deceased person had 5,000 Rand. That's collected, right? That's money that's there. However, when you close the bank account today, there's no longer 5,000 Rand in that account. There is maybe 4,200 Rand in that account. So 800 Rand was lost from 6 February till today. Now, practically speaking, ladies and gentlemen, how do we lose 800 Rand over the course of 5 or 6 months? It's bank charges, right? Every month, bank charges went off that account, and so far, 800 Rand bank charges have been lost. So money was lost after date of death. That money lost after date of death, that 800 Rand, we need to put in our income and expenditure account. That'll be an expenditure, it'll be a loss after date of death, because the money was lost after the day the person passed away. So in our liquidation account, we will have 5,000 Rand in our ABSA bank account, because that's what we had the day we died. However, in our income and expenditure account, we will show a loss of 800 Rand in our expenditure account, because that was lost the day, or that was lost after date of death. So importantly, ladies and gentlemen, and I'm speaking specifically about money, not assets, because you can't say selling an asset after date of death is now income and expenditure. No. You had that asset the day you died, right? So that's why I say when we speak about selling assets, we always use the sold for price in the liquidation account, because the day the deceased person passed away, they had that asset. When we talk about money in a bank account, and that money becomes more or less after date of death, the amount that becomes more or less after date of death is for your income and expenditure account. That is when I want us to focus on the income and expenditure account. Okay, so these are some tips, right, to remember how to describe an asset. It's either awarded, realized, or collected. Then to remember, if an asset is sold, we always use the sold for price in our liquidation account. In other words, the realized price. And if money becomes more or less in a bank account after date of death, in the liquidation account, we use how much was in that bank on the date of death. But in our income and expenditure account, whatever money was made or lost after date of death will then be resembled in that income and expenditure account. And as we get there, I will illustrate that to all of you. Okay, so here's some tips. Let's go on to page 2 now. We go on to the actual drafting of the liquidation account. Now, ladies and gentlemen, you can see what I've done is I've sort of given you an example of each and every asset, how you go about describing it, and you'll see I've put X's all along the way. X's resemble where the value of those assets must come into. Obviously, this is completely fabricated. I'm not working with a real life example here. I'm just illustrating to you how you might go about drafting your L&D depending on what your factual circumstances are. Now, in the liquidation account, we said that's what we want to focus on today. You'll see I have a description column, item column, calculation column, a negative and a positive column. Now, obviously, we describe all our assets here. I told you that's what makes the liquidation account long, is the fact that we have to describe all of our assets. We have an item column. Here we are simply just numbering our assets. 1, 2, 3, 4. So nothing special there. You'll see later on why we actually number those assets. The calculation column is something you might not want to use or you might not need. It's just an extra column I give myself in case I need to add or minus things. And then importantly, we have our negative and our positive column. Negative means minus, positive means plus, obviously. So all our assets is positive. All our liabilities and estate duty is negative. So when we're adding things up, we put it in the positive column. And when we are minusing things, we know in our liquidation account, we have to minus our liabilities and our estate duty from our total assets. We'll obviously put that in our negative column. That is a loss. So assets, we said we divide into 3 categories. We had immovable property, movable property, and claims in favor. So immovable property obviously resembles your home, your residential address. So when we talk about immovable property, we talk about describing it. 4 things that stand out for me, ladies and gentlemen. You know, saying that you live at 115 Bospan Street means absolutely nothing. Not in a legal sense. That's just your address according to Google Maps. In a legal sense, when we describe immovable property, we speak of the earth number. We speak of what province do we find that property. We speak of what is the title deed number to that property. And we speak about what is the size of that property. So we measure property in square meters, right? If it was a farm, it would be measured in hectares. So just make that differentiation. Once you've said the earth, the province, the title deed number, and the size of the property, you have now sufficiently described your immovable property. You'll see it's my first asset over here, and then I'll put an X over here. Obviously, the value of that property you're going to put in your positive column. Now, ladies and gentlemen, let us say this property was a house that you left behind when you passed away. You agree a house is a non-cash asset. It's an asset we can see. It is not money. So if I'm saying this house is valued at R1 million, if I put R1 million over there, the question is going to be, you do not have R1 million in your bank. How do you know that house is valued at R1 million? So when you're done describing it, you can see you must value it. I just said valued by ABC estate agents. In other words, whoever came and valued that immovable property for you, you need to specify who valued it. Because we need to know how you got to that figure over here. That's the people who valued it. If you recall from our discussion on top here, if you can see the asset, in other words, if it has not been sold for cash and is not cash, then it is awarded. The moment you award something, it means it is not cash, meaning when you are done describing it, you must say who valued it and you must give it away. Awarded to. I put a question mark here because it depends on your scenario how you're awarding it. I told you when you give an asset away, always take cognizance of the fact of the marriage. If there's a marriage in COP, half needs to go to your spouse. If there's no such marriage, then obviously we don't worry about marriage. But then we start looking at if there was a legatee for that house, or if not, who are the heirs of the will, because they're going to share in that house. If the person died intestate, you'll have to do your intestate law calculation to see who's entitled to the house. But whoever has rights as beneficiaries to this house, you'll mention over here the people that are entitled to this property. Okay? And that's the same process we are going to follow every single time we have a non-cash asset. Describe it, value it, give it away. Right? Item 1, we put the value over there. So that's how you'll deal with your immovable property. Ladies and gentlemen, just for argument's sake, let's say that this house, we sold this house for 1.2 million. Okay. Let's say as executor, we were instructed by the heirs to sell this house for 1.2 million. Then over here, I'm not going to have R1 million, right? We said we always use the sold for figure. I'll have 1.2 million there. But that means I have 1.2 million rand cash if we sold the house. So when I'm done describing it, I wouldn't value it and give it away. When I'm done describing it, I would just simply say realized. Remember the rule. If you have cash, don't value it, don't give it away. We keep it because we've got to see later if we might need that cash to pay certain people in cash. So when you're done describing, we would just say realized. But typically, ladies and gentlemen, in reality, it's very rare that you would see a immovable property being sold. That immovable property will be transferred into an heir's or beneficiary's name. So usually it would have to be valued and awarded as such. That's why I've said awarded. I'll try to make it as practical as possible. When you're done specifying your movable property, you move on to your movable properties. Now, yeah, we'll have a look at common movable properties that we could find in a deceased estate. Now, obviously vehicles, ladies and gentlemen, play a big part here. So how do we describe a vehicle? Okay, I've just made an example of a BMW X3. And importantly, you need to give the vehicle's registration number. You can also speak of the make and model. I'd probably advise that. But yeah, when describing a vehicle, the registration number is very key. As you can see, I've just said the type of BM, and I've said the registration number. Probably in reality, you could put the model as well, what year model it was. This is my second asset, and I obviously go put the value of the asset over there. I assume a car is a car, it hasn't been sold, it's still there. So it's a non-cash asset. The moment it's a non-cash asset, you would value it. I just said valued by BMW Motors. In other words, they are the proof of how you got that figure over there, right? And because it's non-cash, we award it. I would 10-to-1 award it the same way I awarded the house, eh? If there's a marriage, give half away because of the marriage and give the remainder to the heirs. But you've got to look at your scenario. You might have a will that says John must get the car, in other words. Then if I had to award the car, I'd have to award it to John because John would be a legatee, right? But yeah, it's not something I can teach you. That's something you'll have to look at what the situation dictates, who's entitled to what asset at the end of the day. All right, so that was our second asset, the vehicle. We go down, another common example of movables is furniture. Now with furniture, the law does not say we need to specify the different types of furniture. So we don't need to say it consists of a couch, a TV, a dining room set, ornaments. We don't need to say that. We can group all the furniture together. We just call it household furniture and effects. That's our third asset, and we obviously go put the value in our positive column. Now, from a practical viewpoint, ladies and gentlemen, it is very difficult to value furniture. Furniture has more of a sentimental value to it, and to get an exact valuation of furniture is quite tough. I mean, a house and a vehicle and things like that, those valuations are market related. I mean, that's what it would fetch on the open market. But furniture, we don't really have a market related value, So you could get someone in to come and value your furniture, because remember this is non-cash, but I've written here per informal valuation, because in most instances, we don't really truly know what the value is of that furniture. So usually with furniture, we just give it away to the heirs. So we'll have sort of an informal valuation, try and get an estimate of what the furniture is worth and award it, give it away to the beneficiaries at the end of the day, right? So yeah, the key thing here was the description was nice and easy. You could just say household furniture and effects, and in reality, it'd be tough to value it. So we'll just say sort of per informal valuation. Next scenario, okay, I've got a firearm over there. Indicate the type of firearm it is, and when we describe firearms, the serial number is important. With vehicles, it's the registration number. With humans, it's your ID number. With guns, it's the serial number of the gun when we describe it. Our fourth asset, our figure goes in there by our positive column. And again, ladies and gentlemen, chances are that gun is going to be passed on to someone else. So if we're saying the gun is 5,000 Rand, how do we know it was 5,000 Rand? Someone must have valued it. So whoever valued it, I just said by Champ Sports, for argument's sake, they would have got to the valuation of that gun and will give the gun away. We'll award it in terms of the will or the marriage or intestate law depending on our situation. Next asset, and ladies and gentlemen, what I want us to gather from point 1 to 4 is it must start sort of being repetition. It must sort of become boring after a period of time because it's the same concept we're doing over and over again. The only thing we have to focus on is sort of learning how to describe each asset, which is, it's not rocket science at the end of the day. From here on forward, you would know a gun is described with a serial number, for argument's sake. All right. The next asset I have is coins. Now, ladies and gentlemen, you know, obviously Kruger Rands you could typically find, but obviously a lot of people might have Bitcoins as well. And it's important you know whatever coins you own is a movable property. There is no hard and fast description to describing coins. You just need to specify what type of coin. So I gave the example of Kruger Rands. You might have a Bitcoin there or whatever other coin you have. It doesn't matter. It's an asset of yours. It's in the positive column. You'll see our sage here realize. Ladies and gentlemen, I need us to make our note here because I don't want us to think, okay, this is always how we do it. I'm running on the assumption that when you passed away, the executor took that coin and traded it for cash. So we had cash for the deceased estate. There's also obviously also a chance that that Bitcoin or Kruger Rand was not sold. It was kept in the market and it's going to be passed on to someone else. I need us to differentiate. If that Kruger Rand or Bitcoin was not sold and was passed on to someone else, it must make sense to you that obviously it is not cash then. I mean, it's a coin. Ultimately, it's not cash. If that coin is going to someone else, and I could not have said realized here, I would have had to value it and award it because it is a non-cash asset. I've said realized here because I'm running on the assumption, or I'm just illustrating to you what you would do if that coin was sold for cash. Maybe we had one Bitcoin. We went on the open market now and we said, okay, a Bitcoin is now valued at 350,000 Rand. And the heir said, you know what, sell that Bitcoin. We don't want it. So we went and sold that Bitcoin or that Kruger Rand for 350,000 Rand. Now I have 350,000 Rand of cash. So I can't value 350,000 Rand of cash. And I said, when it's cash, we don't award it. So I would have simply just said realized. A lot more of an easier procedure when you realize or collect it because we don't have to value it and we don't have to give it away. But again, it doesn't mean it's always going to happen this way. You've got to look at your circumstances. That's why it's very important to distinguish between things that are awarded, realized, and collected. Okay. Next one. Importantly, ladies and gentlemen, shares in companies are movable assets. Right? Private companies, public companies, doesn't matter. Any shares in a company is regarded as a movable asset. Now, I gave you an example here. We have ABC Company Pty Ltd. That's obviously a private company because of the Pty Ltd. You'd indicate how many shares you have in the company. And importantly, ladies and gentlemen, obviously, if we want to describe the company, we've got to give the company's registration number. That's, probably par level with our ID number in terms of our descriptions. So indicate how many shares you have in the company and what the company's registration number is. Ladies and gentlemen, important to remember with a private company, when you are done describing it, you must say the following words. Per auditor's valuation approved by Chief Revenue Inspector. Okay. That's just something that must be there. All shares in a private company, doesn't matter if it was sold or not. You need to say per auditor's valuation approved by Chief Revenue Inspector. So I would venture to say that companies is sort of an exception to the rule. Because if you can see over here, I went on the example that the shares were sold for cash. Okay, so I said realized. Now you would say to yourself, okay, but if it's realized, all I have to do is describe it and then say realized. I don't have to value it and I don't award it because it's cash. But you can see here with my private company, I did sort of value it. Just make a note, it's just the exception to the rule. Private companies and public companies, you always need to say sort of how you got to that valuation. It's just the rules. Private company, it's the auditors who value it and it's approved by the Chief Revenue Inspector. So again, ladies and gentlemen, if I am saying here that this company shares were realized, I'm actually saying that the shares in the company we sold. So perhaps, the shares in the company were valued at 150,000 Rand. but we were able to sell it for 180,000 rand. So we decided, let's sell the shares in the company. I would put you 180,000 rand, eh? Not the value, but what it was sold for. Always a sold for price. But if the shares were not sold, in other words, the shares were still there and the shares were going to pass on to an heir, you must also understand that shares on its own is not cash. It's shares, right? So if we were going to pass the shares on to someone else, then I could not have said realized. I would have had to say awarded to that person, because realized is only when the shares have been sold for cash, when anything has been sold for cash at the end of the day. Okay, that was our 6th example. And 7th, I've done a public company now. So just a DEF company, LTD. Obviously, the LTD dictates that it's a public company. You follow the same concept for me when describing it. You see how many shares you have in the company, and you give the company's registration number. Our 7th asset, and we put the value in our asset column there by the X. Now, with a private company, I said when you're done describing it, you say that per auditor's valuation approved by Chief Revenue Inspector. When it comes to a public company, you always say per stockbroker's valuation. Okay, so that's just study work as such. And please remember, ladies and gentlemen, these companies are an exception to the rule about how we learn what to do, when to award, when to realize, and when to collect. Companies, just make your note, you must always value it. Doesn't matter if it's awarded or realized. Okay? I said you're awarded to. So I'm just illustrating that perhaps your shares in the public company were just passed on to another person and was not sold for cash. If it was not sold for cash, it's a non-cash asset then, obviously, meaning it would have been awarded to that individual. So always differentiate whether you have cash or not. If you have cash, obviously we've sold the asset for cash, then it's realized. If it's a non-cash asset, obviously worth a heck of a lot of money, but it's not cash, it's just valued, and we have to award it at the end of the day. We follow that same procedure over and over again. All right, so that's typical movables that we would find in a deceased estate, possibly. Then we go on to our 3rd different type of asset. Please note we keep numbering our assets as we go along. And we said the 3rd different type of asset would be claims in favor. Now, I mentioned last week, these are things that are cash already generally. So things to look out for here under claims in favor would typically be money in the deceased estate bank accounts, any money in the bank accounts, as well as any policies that pay out into the deceased estate. Because this is going to be cash, so we can't award it because remember it is cash. And we can't say realize. I didn't have to sell anything to see this money in the bank account or to see this policy pay out. Nothing had to be sold, so it was cash already. Hence, everything in your claims in favor is generally collected, as you can see with my examples over here. So for argument's sake, the deceased passed away and had 5,000 rand in their ABSA bank account. Under claims in favor, you describe the bank account. With bank accounts, you always say what bank, what type of account, and what is the account number. That is how you successfully describe bank accounts. 8th asset, you put how much money was in the bank over there. Ladies and gentlemen, this is cash now. We can't value cash, so the moment it's cash, we skip the valuation. And if it was cash that's already there, we say collected, hey? If it's cash, you're either going to say realized or collected. To differentiate between the two, realized is when you sold the asset for cash, collected is when the cash was already there. You didn't have to sell anything for it. Obviously, we didn't have to sell money in the bank account to get money, hey? So it was collected at the end of the day. Again, in our positive column. And that's how you'll deal with all the monies in the bank accounts. Just make a note. Remember, this is how much was in the bank account as per date of death of the deceased individual. Okay, that's very, very important. Now, where people tend to get confused with is life policies. So I want us to have a bit of a discussion about life policies, right? Now, there's 3 life policies that sort of spring to mind with me. And I think our basic understanding would be that surely life policies don't have a home in a deceased person's liquidation account. Because what is the point of a life policy? The point would be if I have a life policy, when I die, money must be paid to my spouse or to my kids or to my parents or brothers and sisters, whoever I elected as a beneficiary to my life policy. So when I die, that money doesn't get paid into my deceased estate. It gets paid straight over to my beneficiary. And that's important, ladies and gentlemen. That's usually what happens. If the deceased person has a life policy with a beneficiary, you cannot include that life policy in the liquidation account. Because that money it's like a pension fund or retirement annuity. That money gets paid out to a beneficiary. It never goes into the deceased person's deceased estate. So if you see the deceased person had a life policy and there was a beneficiary to that life policy, please do not touch that life policy in the liquidation account, because it is not an asset of the deceased person. That money got paid over to someone else. So the question would be, when would we find policies or these life policies being paid out into the deceased estate? And two sort of circumstances spring to mind. The first one is you as the deceased person might have had a life policy. And obviously the aim is when you die, money gets paid to a beneficiary. But what happens when there is no beneficiary? Right? And you would say, okay, but how can there not be any beneficiary? Let us say, for example, I said, here's a life policy. When my wife dies, she will get 5 million rand. All right. So I take out this life policy and life carries on. And then unfortunately, my wife dies before me. And then I don't do anything about the policy. I just keep paying the policy and I keep the policy alive. And obviously my wife was supposed to get money when I died, but she died first. So a couple of years later, I then go and die. So the life, and I didn't make mention about my wife's death in terms of the life policy. So I pass away and then the policy wants to pay my wife, but they say, okay, your wife doesn't exist. She passed away many years ago. All of a sudden, we have a life policy that has no beneficiary. And the moment a life policy has no beneficiary, the rules is that policy will pay to the deceased estate then. It will be seen as an asset in the deceased estate. And that policy will be distributed in terms of the will or in terms of intestate law. But it is not a natural thing for this to happen. So let's say we had a life policy where we had no beneficiary. Now we know, okay, there's no beneficiary to the deceased life policy, so we must pay it into the deceased estate. So let's say it was a Sanlam life policy, asset 9. When we describe life policies, please, ladies and gentlemen, we describe it through a policy number. So have a look at what the policy number is. And you'll see I wrote no beneficiary. Personally, ladies and gentlemen, it is not every day you see policies that are paid out into a deceased estate. So if I put a policy in my liquidation account, I just in short indicate why I'm putting it there. You'll see I wrote here no beneficiary. And I'm just writing that in case anyone has a look at my L&D account and thinks that I'm mad. Why am I including life policies in the deceased estate? By reading the words no beneficiary, they're going to know, okay, there was no beneficiary available to claim this life policy. So the rules say when there is no beneficiary, it pays out into the deceased estate and gets transferred to the heirs. So by saying no beneficiary over there, I'm just telling everyone, relax, this is why I'm including it, there is no beneficiary. Obviously, we put the value in our asset column and it's collected because it's money, right? It's a cash asset, so it's either realized or collected, ultimately. Right, so there's an example of when we would find a life policy that pays out in the deceased estate because there was no beneficiary, right? But I'm currently speaking to you about life policies over the deceased life. I could easily be speaking to you about life policies over my wife's life, in my example now. She could have had a life policy that says, when she dies, I must receive 5 million rand. Okay, but then I go and die first. Now, every time your beneficiary in a life policy passes away before you, you have two options, right? You either, and this is the usual option, you'll just change beneficiary and continue the life policy, right? Make someone else the beneficiary. But some people don't want to do that. They don't have, or they don't see any other reason for continuing their life policy. Because maybe she just had me in her life and she's the only one, I'm the only one she wanted to leave this money towards. And we don't have kids or anyone else we can take my place. So she decides, well, you know, if Carl's passed away, I don't have a point for my life policy anymore. So I'm going to cancel my life policy. And what will happen is that life policy will then pay out what they call a surrender value into my deceased estate. Okay? The surrender value meaning, remember, if we think logically about it, if my wife died first, I would have received a life policy payout. And when I would have received the full payout, which we call the maturity value. Okay? But now I died first. So my wife's life policy doesn't make sense anymore because I was the only beneficiary. She doesn't want to change beneficiary, so she cancels it. And what happens is that policy will pay out into my deceased estate, what they call a surrender value. So it'll pay out a small portion into my deceased estate because there's no purpose for that policy to continue because the beneficiary has died. So if she elects to cancel that life policy, then my deceased estate will receive that surrender value payout. So in the example over here, we have the Liberty Life policy. Obviously, when we describe a policy, we have the policy number. And then over here, you can see, again, because it's a policy in my estate, I do feel the need to, in short, just indicate why it's here. So I wrote here surrender value. Surrender value would tell those people who understand our L&D account that, okay, this was not a life policy over the life of the deceased. This was a life policy over someone else's life, but the deceased was a beneficiary. And when the deceased died first, they decided to cancel the policy, and the policy paid out a surrender value into the deceased estate. Obviously, that money to be distributed amongst the heirs in terms of the deceased estate, and that is collected. Okay, so when we speak about claims in favor, I think money in a bank account is easy enough. Policies, just keep in mind, ladies and gentlemen, it's obviously not natural. Usually large policies will have a beneficiary. If there's a beneficiary, we do not touch it because it is not our deceased estate money, it is someone else's money. But on two instances, we may consider including it. One is when we had a life policy and we had no beneficiary for whatever purpose. I illustrated an example now to you. We'll have to include it. And the third issue over here is possibly when we are the beneficiary to a life policy and we unfortunately died first. And the holder of that life policy decided to cancel the life policy and then paid out a surrender value into the deceased estate. So those are the two types of policies, specifically to look out for when dealing with a person's liquidation account. Other than that, generally any life policies will be paid out to a named beneficiary and would not form part of our liquidation account. That is the natural way that things are done. Right. So that's sort of the claims in favor I wanted to show you. So now we have listed all our assets, divided into three categories: claims in favor, movables, and immovables. So what we do now, ladies and gentlemen, is we go and have a look at all our assets and we go and count how much money we have. How much we add all of these up. I mean, obviously some is cash and some is valuations, it doesn't matter. We add all of these X's up that I've done over here. And when we've added it up, we get our figure over here, our total assets. Add everything up and we have our total assets, and we're going to put our total assets over here in this column. Right. We know that is now our total assets of the deceased estate. In other words, the gross value of the deceased estate. In order to get the net value, how much the deceased person was actually worth, from this figure, we need to minus liabilities and estate duty. That will give us the net value of the deceased estate, what we call the balance available for distribution. That is what we're trying to calculate over here. Right. So from here, we can start minusing liabilities. You can see my next heading is liabilities as such. Okay. Ladies and gentlemen, that's the assets. All right. I note it is 10 to 12. So I think let's take a 5-minute break. Then we come back and we start focusing on these liabilities. All right. So I'll catch you all in 5 minutes from now. Thank you. All right, ladies and gentlemen, we are now back. We've had our little break. Let's do our second session before we head off into possible questions on this. So we basically looked at the assets in the liquidation account, and I'm sure you possibly see what I mean when I say it's obviously the longest account. It's all of these descriptions that we have to attend to in describing assets that sort of take up most of the space. Now we know from our total assets, we need to minus our liabilities because we're trying to figure out what the net worth of this deceased estate is. So liabilities, we spoke last week during our seminar, and I said basically in liabilities we divide this into two subheadings. You have your administration expenses and you have your creditors. So your administration expenses, my first one here, ladies and gentlemen, these are the natural expenses incurred in the deceased estate. You know, and if we go back to our steps in winding up a deceased estate, you'll recall we had to open a deceased estate bank account. Now, obviously, that bank account is going to have bank charges. That's going to be a loss for the deceased estate. Our step 3, and I think it was step 5, if I remember correctly, we had to do advertisements. We had the section 29 advertisement and the section 35 advertisement. Now, those advertisements is going to cost money as well. If you look at all these assets that we valued, all the assets we awarded, we had to value. I mean, the house was valued by estate agents, the vehicle was valued by BMW Motors, the furniture was possibly valued, our firearm was valued, our public company was valued. Everything that was awarded had to be valued. Now, all these valuations are not for free. People charge for doing valuations, so those valuation costs is also going to be incurred. Our immovable property, our Earth 678 we had on top, that movable property is going to be transferred to a beneficiary. So there's going to be transfer costs, conveyancing costs for transferring that property to the beneficiary. The deceased estate must pay for all of this. Us as executor, we are entitled to 3.5% of the total assets of the deceased estate. So this figure, whatever this figure is, we are entitled to 3.5% of this figure. That is our payment for winding up this deceased estate. Obviously, our fees must also be minused as a liability. The master is entitled to fees. That is minused. You see, I have your postage and petties. That is sort of a general admin expense. I mean, obviously, in the process of winding up this deceased estate, you might have had to travel, incurring traveling costs. You had to print paper, make copies of things, obviously paper-related costs. Any usual office-related normal costs that we incur, we put under postage and petties. That's the cost we incurred in winding up this estate. And then lastly, you see I have commission costs. Interesting. That's something some people make a mistake with when doing the L&D account. In our example, let's try and make this practical. Let's have a look what was realized. Okay, so the shares in the company was realized, our coins were realized. Okay, now realized means it was sold. Now there's a chance that we didn't sell these assets. There's a chance we employed someone to sell these assets for us. Now if we told someone to sell these assets for us, there's a chance that we had to pay them commission, right? If we employed the services of any professional to sell any of these assets for us, and we had to pay them commission as a result, that commission cost is an admin expense because it was done in the process of winding up the deceased estate. So ladies and gentlemen, everybody has admin expenses. You can't walk away from it. Everyone will have. Obviously, some people will have more than others. Some people might not have had property to transfer, so there won't be transfer costs, conveyancing costs. Some people might not have sold any assets when winding up the deceased estate, so there won't be commission costs. So it may differ, but it's something that we can't escape. So these are the expenses that we incurred when winding up your deceased estate. There weren't actual liabilities there before you passed away, but they're liabilities that incurred when we winded up your deceased estate. So that's the first type of liability. You can see I put it in my negative column because we're minusing now, minusing liabilities. This is maybe an example of when you could use your first column, because perhaps all of these costs I want to put in my first column over here. Add them all up, then I will have my total admin expenses, which I can then go and put in my negative column. I mean, but if you wanted to put each and every single one over here and then add it up and get your total admin expenses, that's up to you. I prefer to just list it all here, add it together and put it in my negative column. Because at the end of the day, I'm going assets minus my liabilities. I'm worried about the positive and the negative column. Right. When we are done with our admin expenses, we move on to our second and final type of liability, which is our creditors. Some people call it claims against the estate. Just make a note, claims against the estate and creditors are exactly the same thing. It's just obviously two different ways of writing it as a subheading. Now, if you recall from last week, our step 3, we had to do our section 29 advertisement in the newspaper and gazette, notifying or calling upon all creditors to lay and prove their claim against the deceased estate. So all of those people who laid a claim as a creditor to the deceased estate will have to include their claims over here. That is our actual liabilities, right? So I just gave an example. Maybe we owed Vodacom money, maybe we owed Edgar's money, maybe we owed the municipality money, maybe we owed money on the bond account of our immovable home. And I think an important point I want to make over here, ladies and gentlemen, is, in our liquidation account, we have to do what they call full disclosure. What I mean by that is if you have a house valued at 2 million rand, but you owe R1 million on the bond, you cannot go 2 million minus 1 million and say I have R1 million asset over here. You can't do that. You put the full value of the asset and the full value of the liability. So if this earth over here was valued at 2 million, but we owed R1 million on the bond, I would have put 2 million rand as an asset here. And then under my creditors, my liabilities, by the bond that we owed on, I would have put the R1 million. So it balances out. It's a 2 million asset, but R1 million we owe as a liability. Never try and subtract the figures from each other. Just mention what the full asset is worth and mention what the full loss is worth. I mean, we maybe still owe 2 million on that bond. Maybe we just bought the house and then passed away. So we had an asset of 2 million, but we owed 2 million on the bond. Then I would have said 2 million rand as an asset on the liquidation account, and then I would have put 2 million rand as a creditor by my liabilities. Always show it, show the full asset, and show the full liability. Obviously, 2 million minus 2 million will balance out to 0, but you still got to show it. And obviously, that's also going to affect our executors' fees. It obviously also affects this figure, what we do on top over here. So the liabilities is quite easy. It's not like the assets. There's no hard and fast rule with how we describe assets. I mean, assets we had to describe, and then it was non-cash, we had to value it and award it. And if it was cash, we had to either realize it if it was sold for cash, or if it was cash that was already there, we had to collect it. Liabilities, there's no such rule. Liabilities, you just mention who you owe the money to, you indicate how much you owe. At the end of the day, you're going to have your admin expenses, and you're going to have all the creditors, all the claims against the state, all the people in terms of our step 3 that lodged the claim and said the deceased person owes us money. You're going to add all of these up, and you're going to get your total liabilities that we have here in our negative column. So in other words, our liquidation account so far reads total assets minus total liabilities. All right. But we know in order to calculate our net value, which is this balance available for distribution, this is obviously a key figure, ladies and gentlemen. This is what is left after you've paid everyone that the deceased person owed. Remember the ranking. The ranking is creditors, marriage, legatees, heirs. So we need to sort out all our creditors over here, minus our creditors from our total assets. That is left, our balance, is what is going to go in terms of marriage, legatees, and heirs. Okay, so this is key. But in order to calculate this, I have to go assets minus liabilities minus estate duty. Our total liabilities and our estate duty, these are our creditors. This is possible money we owe to SARS that we could be taxed on even when we die. Unfortunately, that is the case. Okay, but at this stage, if you recall last week, I said you can't finish your liquidation account because you need to calculate what you owe SARS on estate duty. That's an account on its own. You see, I have my estate duty account over here. So what I do is when I've got my total liabilities here, I write estate duty and I leave this open. I write balance available for distribution and I leave this open. Because this answer over here is total assets minus liabilities minus estate duty equals that. But I do not know what my estate duty is at this point. So what do? I leave that open and I leave that open. I then move on and I go and start my second account, my estate duty account. Technically speaking, it is the estate duty addendum. I go and calculate if there's any possible money I owe to SARS, get my answer, put it back in here, and then I go assets minus liabilities minus estate duty equals that. So you see, you cannot finish your liquidation account without finishing your second account, which is your estate duty addendum as well. Okay. Now, let us have a look at how we would draft our estate duty accounts. Now, ladies and gentlemen, over here on top, all I'm doing here is I'm giving you the formula. Okay, from here down, we'll look at how we draft it, but I want us to just understand the formula. Also keep in mind, ladies and gentlemen, with the liquidation account, these total liabilities, we need to pay these liabilities, all right? We need to pay the estate duty over here to get, and once we pay these two, assets minus those two figures will obviously give us that balance, okay? In the estate duty account, we are literally not paying anyone over here in our calculations. We are just following a formula to get our end answer, our estate duty figure. That over there is what we owe SARS. All these other things in between, we're not giving money to anyone. We are just following the formula. Okay, so we've got to learn this formula. The formula is property plus deemed property less, okay, when you see the words less in estate duty, it means minus. So I'm just going to rather say minus, it might be easier to follow. Minus section 4 allowable deductions, minus section 4A primary rebate of 3.5 million equals a figure. That plus that, minus that is going to equal this. That answer we call our dutiable amount. 20% of our dutiable amount equals the estate duty that we owe. So from the primary rebate down, it's actually easy. We need to figure out what is property, what is deemed property, and what is allowable deductions. Once we know what these three things are, we can actually do the sum. Because when we reach this stage, minusing the primary rebate of 3.5 million, ladies and gentlemen, that is just law. Currently, we all have a primary rebate of 3.5 million. In other words, if property plus deemed property minus allowable deductions gives us an answer of less than 3.5 million, we've still got to minus the 3.5 million, meaning we're going to get a negative answer. Now, you can't get negative in estate duty, you get nil, NIL. If your answer is negative, you get 0, in other words. Obviously, 20% of nil equals nil. That just means you don't owe SARS anything. It is when that, plus that, minus 3.5 million, gives us a positive answer. 20% of that positive answer, of that dutiable amount, is our estate duty. So you've got to think to yourself right now already, you've got to have quite a wealthy estate before you're going to owe SARS anything. Because that plus that minus that must be more than 3.5 million before you're going to get a positive answer over here. Right? Then only you're going to owe SARS. So a lot of people don't actually owe SARS anything. You still got to do your estate duty calculation. You still got to show that they owe SARS nothing. So you've got to follow your formula. But ultimately, you've got to calculate it and you've got to put this answer over here in our liquidation account. Okay, so let's try to figure out what property is, what deemed property is, and what allowable deductions is, because that's going to help us doing our estate duty account. So we start off with the term property. Now, ladies and gentlemen, I think before we get going, let us understand this. Estate duty is obviously bad. It's tax you owe. So anything we are plussing is not good, right? The more we plus, the more the chance that we're going to owe SARS money. The more we minus, the better. The lower the figure is going to become. Obviously, at certain stages, we can't escape it. If we've got a very wealthy estate, the reality is you are going to be taxed on it, you know. But just so that we understand that plussing things is obviously not positive, because there's more of a chance we're going to pay estate duty. We want a negative. We want to minus things. So anytime I say you minus something, you need to understand that's a good thing. SARS is giving us some form of rebate on something. And we also got to understand that what we regard as our assets in real life is not what SARS regards as our assets. Right? They've got a different viewpoint over what is taxable and what is not taxable. At the moment, we're trying to calculate what we have according to what SARS believes is taxable, not according to what we might or might not have. Okay. So our first step of the formula was we had to calculate what is our property. So ladies and gentlemen, your property is your total assets. Where do I get my total assets from? I get that from my liquidation account. Hence, we couldn't just do our estate duty account first. We had to do our liquidation account, so because we had to get our total assets and total liabilities. Our total assets over here, there, that figure is what we're going to go and put down on our estate duty account underneath property. That is our total assets. Okay, so we take that straight from the liquidation account. But SARS is saying, okay, based on your total assets, we'll give you a rebate on potentially two things. Okay, in other words, two things we won't hurt you with on tax. Right. So over here, I've shown you. You can possibly minus 30% of a farming undertaking, or you can possibly minus the difference in private company shares. Now let's talk about each of this. Our immovable property right on top, our Earth 678, that was just a normal residential property, okay? I mean, it was measured in square meters, so unfortunately that is not a farming undertaking. But what happens if Earth 678 was a farm, right? Remember, there's a difference between a farm and a farming undertaking. A farm is just agricultural land where a person lives. A farming undertaking, people don't just live there, but they actually commercially farm on that property. They are saying if your immovable property was a farming undertaking, the value of that farm, 30% of that value we won't tax you on. We don't want to tax you on the full value of your farming undertaking. We'll only tax you on 70% of it. So we'll give you a rebate on 30%. In other words, obviously that farm formed part of our total assets. If we did have a farming undertaking, 30% of the value of that farm we could minus. That's a positive thing. They're saying we won't tax you on 30% of the value of the farm. So if our farm was valued at 2 million, I mean 30% of 2 million is around 600,000 rand. So we could minus 600,000 rand from our total assets. It's a positive thing. So I was saying we don't want to tax you on that. So that's a very good thing. The next example over here is difference in private company shares. Ladies and gentlemen, I think there's two important notes to make over here. Number one, this is only when there's shares in a private company. Emphasis on the word private company. So public companies or CCs, whatever the case may be, or limited liability companies or whatever, that's of no concern. I'm only referring to private companies over here. Secondly, this is only when the shares in a private company are sold for more than what they are valued at. So this is only when shares in a private company are sold for more than what they were valued at. SARS is saying, we don't want to tax you on the full amount of those shares that you sold. We'll rather just tax you on what they were valued at. So we'll give you that rebate. I mean, if the shares were valued at 500,000 Rand, okay, and they were not sold, then obviously this bears no reference, because this is only when shares are sold. If the shares were valued at 500,000 Rand but sold for 480,000 Rand, remember in our liquidation account we would have put the 480,000 Rand, the sold for price. Then again, this bears no reference, because this is only when shares are sold for more than what they were valued at. So if our shares were valued at 500,000 Rand, but were sold for 550,000 Rand, remember in our liquidation account by our private company, I think we had that ABC company, we would have put the sold for price over here of 550,000 Rand. So if they were valued at 500 but sold for 550, we would have put 550 here. Always a sold for price. But SARS is saying we don't want to tax you on that 550. We'll just tax you on the 500,000 rand, what it was valued at. So the difference between the valuation price and the sold for price, we can minus. In my example that I'm giving you, we valued it at 500 but sold it for 550. So there's a 50,000 rand difference. SARS is saying minus that 50,000 rand. We don't want to tax you on that 50,000 rand. So the difference between what the private company shares were valued at compared to what they were sold for, that difference we can minus from our total assets as well. That's another rebate that SARS is giving us. Again, ladies and gentlemen, this is only if your shares in the private company were sold for more than what they were valued at. In other words, SARS is saying what we regard as your property in your deceased estate is your total assets, which you got from your liquidation account, minus potentially 30% of a farming undertaking if you had a farm, and minus potentially the difference in a private company shares if your shares were sold for more than what they were valued at. But ladies and gentlemen, a lot of people don't own a farming undertaking. A lot of people don't have shares in a private company. In other words, you will leave this. Your property will then simply just be your total assets, as simple as that. This just depends from person to person. Have a look at the deceased estate, see if there's a farming undertaking, see if they had shares in a private company, and if so, if they meet the criteria, we could potentially minus these two things from that figure. Obviously, our total assets minus that is going to give us this, our property, in other words, okay? So it depends from deceased estate to deceased estate. Once we've done this, we now have our total property. If you look at our formula is property plus deemed property. So over here, after we have our property, I move on to plus deemed property. Now, interesting, deemed property, ladies and gentlemen, and you can make your note to this regard. This is not what me and you regard as our assets. This is what SARS regards as our assets. I think the words deemed property, property deemed to be property, that word deemed, I think says a lot. It says we deem it, we regard it to be your property, even though you may not regard it as your property. Okay? So this is the killer, in other words, when it comes to tax. Do you have any deemed property? Because this could seriously impact whether or not you're going to pay tax or not. And I've given you 3 examples of typical forms of deemed property: donations, accrual claim received, and life policies with named beneficiary. I want to chat to you about each of these 3 scenarios and maybe practically explain to you how these might arise. Okay, so they say any donations made into the deceased estate is taxable for the deceased estate. Now remember, we did not regard donations as our property because this donations came after we died. It came into the deceased estate. Why would someone want to pay money into a deceased estate? Why would someone want to give the deceased estate money? Why would they donate money into the deceased estate? Well, let me give you a practical example. There might be a house that someone's supposed to receive, but there's not enough cash in the deceased estate to pay the creditors. Now remember, creditors are ranked first, they must be paid. So you as executor approach the legatee to that house or heir to that house, and you say, listen, unfortunately, the house is valued at 2 million, but we're short 500,000 or we're short 300,000 rand because we need to pay the creditors. We don't have any other assets to sell, so we have to sell this house so that we can raise that 300,000 rand to pay the creditors. Whatever is left after the sale is yours because you were entitled to the house. But you as the legatee to that house, you think to yourself, well, I don't want you to sell the house. I want to keep the house. And you tell the executor, what do we owe the creditors? And you say, well, you owe the creditors, the deceased estate owes the creditors 300,000 rand in cash. That's why we have to sell assets. And this legatee to the house says, well, I will rather pay 300,000 rand so I can keep the house. Because I believe from a financial perspective, it's going to be better for me to actually keep this property. So I will donate 300,000 rand into that deceased estate so that I can keep this house. And you can use that 300,000 rand to pay the deceased estate creditors. So that's a typical real-life example of why someone would donate money into the deceased estate. But SARS is saying, That person who donated the 300,000 rand, you as the deceased estate must still pay tax on that donation. You will still pay tax on that 300,000 rand. That is why we regard it as a deemed property. Okay, the next one I deal with here is accrual. So ladies and gentlemen, I take us back to the marriage regime. If you recall, not that we spoke too much about marriage regimes, but obviously if you're married out of community or property with the accrual, the effect of that is that whatever you accumulate during your marriage is split 50-50 upon termination of marriage. I think that wording upon termination of marriage is very important. Because even if you're married with the accrual system, you're still married out of community or property. Meaning, if I make R1 million today, it's not half my wife's and half's mine. It is my R1 million. But if we divorce tomorrow, she's entitled to half of that R1 million, in other words, right? Because accrual only comes up the moment the marriage is terminated, either by divorce or by death. So let us say I was married out of community of property, but with the accrual system. Now I pass away. Now obviously we need to calculate who's entitled to what from the marriage. And we have a look and we see, hold on, my surviving spouse made more money than me during our marriage. She made R1 million more than me. Meaning I am entitled to half of that, to 500,000 rand. Half of what she made more than me. Therefore, the deceased estate has an accrual claim against the surviving spouse of 500,000 rand. SARS is saying, yes, your surviving spouse must now pay 500,000 rand into the deceased estate because it's the accrual claim. That was the effect of the marriage out of community property with accrual. Because my spouse is now paying the 500k into my deceased estate, SARS is saying, yeah, I mean, when you were alive, it wasn't your asset. But because the spouse is paying this into the deceased estate, we are going to regard it as your asset. So we are going to tax you on any accrual that your deceased estate is entitled to, the same as donations at the end of the day. So that's the unfortunate reality. And the third and final type of deemed property that we're looking at here, and this is quite a common scenario. Look what I say, a life policy with named beneficiary. This is a bit of a shocker. Earlier on, I spoke to you and I said, if the deceased person has a life policy with a named beneficiary, do not include it as an asset in the liquidation account because it is not your asset. That money is not being paid into the deceased estate. It is being paid straight to the beneficiary. SARS is saying, yes, you're right, it's not your asset. But for purposes of tax, we are going to deem it to be your asset. We are going to deem it to be your property. So if you had a life policy that says, when you die, 5 million rand must pay to your children. Right. When you pass away, that 5 million rand is paid straight over to your kids. All right. It doesn't form part of your deceased estate. However, when we calculate estate duty on your deceased estate, we are going to include that 5 million rand over here in the deemed property. Unfortunately, it is taxable. The rules say any life policy over the life of the deceased that has a named beneficiary, yes, it was not our asset, but for tax purposes, you will still be taxed on it. I know a lot of you will say, well, this is not fair. And yeah, whatever the case may be. The reality is whether we think this is fair or not, or however we feel about this, doesn't impact that the law is the law. So you will need to include life policies with a named beneficiary under deemed property. Remember, this was not an asset in our liquidation account, but for tax purposes, it falls under deemed property. SARS will regard it as an asset. That's the unfortunate reality. And maybe that might make you think a little bit about your estate planning as well. Because estate planning is a strong consideration of any possible tax that you might need to pay when you die. Because the more tax you pay when you die, the less there is for your beneficiaries. Nevertheless, we had our property over there, plus our deemed property. So now I add my deemed property together. Ladies and gentlemen, again, there might not be any donations to the deceased estate. There might not be any accrual. There might not have been a marriage with the accrual system. There might not have been any life policies with named beneficiaries. If not, you would have just left deemed property alone. Okay, I'm just illustrating different versions of property, different versions of deemed property, in case you come across something like this in the future, so you know where to put it under estate duty. So you add your deemed property up and you'll now have your total deemed property. So at the moment we have assets plus, we have property plus deemed property. Right. We look at our sum, property plus deemed property, but there's one other thing we need to figure out. What is allowable deductions? We now need to minus our allowable deductions. So you see underneath deemed property, I write less our allowable deductions. Less means minus an estate duty. So I've written down a couple examples of things that you will not be taxed upon. Allowable deductions means you can minus these things from our above figures. This is a good thing. So I was saying we won't tax you on this, anything in the minus column. First things first is our liabilities. Again, ladies and gentlemen, you go to your liquidation account and you go to your total liabilities. Have a look what your total liabilities was, and we put it down under allowable deductions. Obviously, we can't just be taxed on what our property and our deemed property is. That won't be a true reflection, because we need to ultimately be taxed on our net value, or let's say SAR's version of our net value. So there's things that need to be minused from here. Liabilities must obviously be minused, because that's going to be subtracted from our assets at the end of the day. Charitable bequests. SARS is saying if you leave any money for a charitable purpose, you will not be taxed on it. Now, ladies and gentlemen, to leave money to a poor family member and to call that charity is not correct. A charitable bequest is when you leave money to a charitable organization. All right? So it could be some form of children's fund or whatever the case may be, but it must be a registered charitable organization. In other words, you're donating money to them. You might have had a will that said, when you die, let's donate 200,000 Rand to this children's fund. SARS is saying that 200,000 Rand that you're donating for a charitable bequest, we're not going to tax you on, right? We'll rebate you on that at the end of the day. So that's another example of an allowable deduction, any charitable bequests. The third one is where things get interesting for me, and I think this really impacts your estate planning going forward. It says here, any life policies where the surviving spouse is the named beneficiary. So in other words, if you have a life policy that says when you die, your spouse must get 5 million Rand, you would agree that is a life policy where your surviving spouse is a named beneficiary. SARS is saying we will not tax you on it. Now I want us to think between this and between this. Let's make sense of it. Deemed property is life policies over the life of the deceased with a named beneficiary. Let's say that named beneficiary was our children. So we had to put and let's say it was 5 million. So we put the 5 million here. We could not minus it here because our children is not our surviving spouse. In other words, we would be taxed on it because we had to name it over here. Okay? Let's say that 5 million Rand life policy over the life of the deceased was payable to our surviving spouse when we die. Again, it doesn't matter that it's our surviving spouse, it's still a named beneficiary. So I have to put the 5 million Rand over here. But because that named beneficiary happens to be my surviving spouse, you can minus the 5 million over here as well. So you would have plussed it and you would have minused it. In other words, are we being taxed on life policies where the surviving spouse is the beneficiary? The answer is no, because we plus it and we minus it. If the beneficiary to our life policy is someone who is not our spouse, we would have just plussed it over here, but we would not have been able to minus it. In other words, we would have been taxed on it. So, ladies and gentlemen, that is something to seriously consider when doing your estate planning. I mean, ultimately, you might have a spouse, you might have kids, and you might want to leave everything to everyone, but you might not have too many assets. So you might think to yourself, perhaps a smart move to do would be to leave all my assets to my children and then take out a life policy in my spouse's name. Because when I pass away, my spouse will be the beneficiary of the life policy. My children can have my other assets. And the positive thing about that is I won't be taxed on that because it will be plus and minus. Plus by deemed property and minus by allowable deductions. But it wouldn't have been too smart then to make your children the beneficiary of the life policy. Because then it would have just been plus, hey? Because they're not your surviving spouse. We could not have minused it over there. And then you could end up having a really big deceased estate. I mean, ladies and gentlemen, you might have an estate of assets worth R1 million. But you might have life policies of 10 million rand paying out if you pass away. Now think practically about it. If you have a life policy of 10 million rand and that person is not your surviving spouse, you're going to put that 10 million rand here by deemed property. You're not going to be able to minus it. So whatever your property and deemed property was, that property might have been 1 million over here. But your deemed property is going to be 10 million because of this life policy. So you're going to have 11 million rand over here. Maybe your allowable deductions is only 1 million. So you sit with 11 million minus 1 million is 10 million. Minus 3.5 million rebate. You're going to have a figure of about 6.5 million. 20% of 6.5 million. I mean, do your maths on that, ladies and gentlemen. That's, roughly 1.3, 1.4 million rand that you are being taxed upon. So that is 1.3, 1.4 million rand less for your heirs just because of your estate planning. So when you do your estate planning, please consider estate duty. You are potentially subjected to tax when you pass away. If you want to try and keep your tax as low as possible and you have life policies, obviously I would recommend that those life policies are in your spouse's name and rather leave your assets for your children, because then you can avoid this tax hiccup over here. But sometimes, ladies and gentlemen, we just don't have a choice. Sometimes we don't have much assets, and the people we really want to leave our life policy to is our kids. Then we do end up taking a life policy in our kid's name. Nothing wrong with that. Just remember that it can obviously impact our tax quite considerably, especially if that life policy is large, 3, 4, 5, 10 million, doesn't matter. Smaller life policies shouldn't have too much of an impact at the end of the day. But I want us to remember, life policies with named beneficiaries was not an asset. We excluded it from our liquidation account. However, for tax purposes, SARS regards it as our asset, even though it is not ours. And remember, we can minus it. We won't be taxed on it if that beneficiary so happened to be our surviving spouse. So that's the third type of allowable deduction I wanted to speak to you about. The fourth one over here you can see is accrual paid. If you remember from donations, I'm back to my marriage out of community of property with the accrual system. And we said deemed property was an example of our surviving spouse owed us money because of the marriage. So in other words, our deceased estate received an accrual claim. We said that's taxable. But what happens if it's the other way around? What happens if when we pass away, we do the accrual calculation, or the executor of the deceased estate does the accrual calculation and says, hold on, the deceased estate, the deceased person actually made more money during their marriage than the surviving spouse. In other words, the surviving spouse is entitled to an accrual claim from the deceased estate. So the deceased estate needs to pay the surviving spouse. If you need to pay your surviving spouse because of accrual, then obviously this is now an allowable deduction. Because SARS is saying, yeah, you might have had assets worth 1 million, but you owe 200,000 rand for argument's sake to your surviving spouse because of the accrual system, because of the marriage regime. So we are not going to tax you on that. Obviously, money you pay to your spouse, that's your spouse's money. When she passes or he passes away, it's their tax worries. It is not yours. So remember, when we deal with the accrual system, if the deceased is entitled to receive an accrual claim, it is deemed property. If the deceased estate must pay accrual to the surviving spouse, it is an allowable deduction. And then if you move on, the very last one, and that's a very general one, ladies and gentlemen, for tax purposes, please keep in mind, anything that goes to your surviving spouse as a result of your death, you will not be taxed upon. So anything you leave to your surviving spouse, SARS will not tax you on that, ladies and gentlemen. That is not just assets, but that includes marriage regime. I mean, if you are married in community of property to, obviously we have one estate here, but when you die, you're only entitled to half of that. Your spouse has got the other half. You should not be taxed on your spouse's half share of the estate. They will be taxed when they pass away. So keep in mind when I say anything your spouse receives as a result of your death is non-taxable. that also includes marriage regime. And I think we see it here with the accrual as well. Hey? The accrual is taken strongly into account. So ladies and gentlemen, that is typical examples of allowable deductions to look out for. You can see everything's in my minus because we minus this is in our minus column. We add all of this up and we now get our allowable deductions. So our estate duty now reads property over here plus deemed property over there minus allowable deductions over there. Remember our formula. Property plus deemed property minus allowable deductions. Okay, we've covered those three. The next step is we've got to minus our 3.5 million primary rebate. That's the standard, hey? It's obviously changed over the years, but it's been 3.5 million for a good couple of years now, for as long as I can remember, actually. So our next step is to just go and minus less our 4A primary rebate of 3.5 million. Okay, that is just, remember that, that's the current rebate in South Africa. So ladies and gentlemen, property plus deemed property minus allowable deductions minus 3.5 million is going to give us a figure. That figure we call our dutiable amount. And then 20% of that figure is going to be our estate duty. That is the tax we owe. Ladies and gentlemen, if your dutiable amount is a negative answer, please remember what I said. If it's a negative answer, you just write nil. 20% of nil obviously equals nil. Then you don't owe SARS anything. But obviously it could be a positive answer as well, depending on your wealth and depending on how good or poor your estate planning was. So I think when dealing with estate duty, it's always important to sort of break each step down over here. What is property? You know, there I've shown you what property is, what property potentially could be. Obviously it's total assets, but potentially we could minus these two things from it. Done. Next step, plus deemed property. What is deemed property? There I gave you 3 examples of deemed property that you look out for. Next step, minus allowable deductions. They have given you allowable deductions to look out for. This is obviously positive. This is things we can minus from our property and deemed property. From there, we minus our rebate of 3.5 million. We all have this rebate of 3.5 million. That's then going to give us this figure, our dutiable amount. 20% of that is the tax we owe. That's our state duty. So keep in mind, I didn't give anyone anything over here. I was just following a formula to calculate my estate duty. Now that I have the estate duty, remember we've got to go back to our liquidation account and go and put the estate duty figure in over there. Okay. Now that it's in over there, ladies and gentlemen, we can go total assets minus total liabilities minus estate duty equals balance available for distribution. In other words, that is the net value of our deceased estate. That is actually what we are worth at the end of the day. This figure is what is left for us to distribute in terms of marriage, legatees, and heirs. Okay, so just to illustrate, you see how dependent these two accounts were of each other. The estate duty account needed the liquidation account because it needed the total liability figure and it needed the total asset figure because they had a home under property as well as allowable deductions. It formed the basis of calculating our estate duty. A lot of people don't have deemed property. A lot of people don't have farming undertakings or private shares. They don't have charitable bequests. They don't have life policies. They're maybe not married. Then estate duty becomes a lot easier. Then there's not much to do over here. Total assets minus total liabilities, kind of. Minus your rebate of 3.5 million. So I'm trying to go as far and as practical as possible with the estate duty to show you the possibilities. But please remember, in reality, there probably won't be all of these things. So it's a lot easier and a lot simpler to do your estate duty. But nonetheless, we had to calculate it. We're only worried about this figure. Don't worry about what we gave people over here. It means nothing. It's just a formula we're following. This figure we take and we put in our liquidation account over here. Then we could complete it. Assets minus liabilities minus estate duty equals balance available for distribution. So, ladies and gentlemen, your liquidation account and estate duty account was very, very dependent on one another. That is your longest account and most difficult account, I would assume. But I hope these notes kind of help you in terms of trying to get an understanding what we are trying to do in these accounts. All right, I see it is 1:45. So we'll follow the same format we did last week. We'll take a 15-minute break, ladies and gentlemen, between now and 1 o'clock. We'll need 15 minutes so I can get all the questions in. And then between 1 and 1:30, I will sit and answer those questions. So I will see you all in 15 minutes. All right, ladies and gentlemen, we are back. Let's work through as much questions as we can. There's obviously quite a bit of questions regarding the L&D accounts. So let's have a look here. Just open up the liquidation account. All right. How will the master know whether you realize an asset at market value if you don't supply any value in the L&D? So just keep in mind, ladies and gentlemen, when an asset is sold for cash, right, you always need to keep proof of what that asset was valued at all times, because it's full disclosure to the master. The master needs to have access to all the information at all times. So it's important that you keep proof of what the value of that asset was, even if you realized it. And if you want to, a lot of attorneys, what they do in the description, they put the value of the asset, and then obviously the sold for price will come over here. So you could include the value if you sold the asset as part of your description, but if not, just make sure you keep proof of the valuation of that market, of that asset. That is obviously to avoid a situation where someone is taking chances and selling assets just for the sake of selling them and not taking into account what is the interests of the beneficiaries. Please touch on surrender value again. I'm not sure I understand. So it would be here, by this Liberty Life policy. Now, remember, when we spoke of life policies, we keep speaking about life policies over the life of the deceased. You know, that either have a beneficiary or don't have a beneficiary. If they had a beneficiary, it got paid over to that beneficiary. So we didn't include it in our liquidation account. But if it did not have a beneficiary, then it had to be paid into the deceased estate, like we did over here. The surrender value, I'm making reference to life policies where you are the beneficiary. In other words, someone else has a life policy over their life and you're supposed to get the money when they die, but you die first. So the beneficiary has passed away, and that individual who had that life policy then decides to cancel the life policy. They don't have a purpose for that life policy anymore because you were the only one that wanted to benefit. So they cancel the life policy and they elect the option where surrender value from that life policy, so a portion of that life policy, will then pay out into your deceased estate. They call that the surrender value. And obviously a surrender value can work both ways. I mean, you could have had a life policy where someone else is the beneficiary and they pass away. And you can also elect to cancel that life policy, and then a surrender value will be paid into their deceased estate. So surrender value refers to instances when you did not have a life policy, but you were the beneficiary of that life policy, but you died first. And that holder of that life policy didn't elect to change beneficiary, they elected to just cancel the policy as such. I hope that assists. Admin expenses. Let's go there. All right. If the executor has used an attorney for various things, for example, conveyancing searches, sale of movables, CIPC requirements, can the attorney's bill be claimed against the estate? Most definitely. Most definitely. Now, where would that bill form part of? It would form part of your admin expenses. Remember, I'm illustrating to you the different types of admin expenses, but it's not to say there aren't different types, right? These are common forms of admin expenses. But there is obviously other examples of admin expenses. And if you had to employ a professional to do something for you, I mean, who's not to say that at the time the deceased passed away, there was a court case running where the deceased was suing for money or being sued for money? You might need to get an attorney to run that case. And that's obviously going to be an admin expense. So anyone who you need to pay or anything you need to pay as a result of successfully winding up this deceased estate will fall as an admin expense. So yes, that attorney, those searches and those CIPC requirements, all those things will be an admin expense. Why? Because you did it for the process of winding up the deceased estate. What is the difference between transfer costs and conveyancing costs? As the conveyancing costs usually form part of the transfer costs. Okay, remember when we speak of this, conveyancing costs is obviously the cost for the transfer from the attorneys and conveyancers. Transfer costs include any other costs involved. I mean, I'm making room for many things here. For example, transfer duty, tax you pay thereon. I'm making room for bond cancellation costs as well. I mean, so this is just a general topic. Any costs relating to the transfer would form as an admin expense. And obviously, when transferring property, there may be costs on top of conveyancing costs. There usually is. The L&D does not make provision for pre- and post-death income tax or for accountant fees. Should this form part of the L&D? Again, back to the admin expenses. Accountant fees relating thereto is obviously incurred for winding up the deceased estate. So that would be another example of admin expenses. Ladies and gentlemen, these are not the only admin expenses there is. It could be anything, all right? As long as it is something incurred for purposes of closing down the deceased estate, it will be regarded as an admin expense. If there is a property, there is no provision made for rates. Can one make provision if the transfer has not been concluded? Well, typically over here, where I said Tshwane municipality, that could be rates. So yeah, often obviously there is perhaps rates outstanding on the immovable property, and that would be a liability. That would be a creditor in your liquidation account, any rates outstanding. And you would need to make provision for that, most definitely. Do you still add VAT over and above your 3.5% executives fees? Most definitely. VAT is obviously not part of your payment. That is for tax purposes. So VAT must be added on top of that if you are VAT registered. Farming undertaking. Small holding with example, tunnel, veg, other farm-like activities, but not big commercial farming as such. Would they be able to have the 30% rebate? Well, the question would still be, I mean, they don't limit or cap it on the size of the farming undertaking. As long as, number one, it's an agricultural piece of land that you measure in hectares, and number two, you were doing some form of farming on it and supplying whatever goods you used to the public, then it doesn't matter if it's only a small one, you would have that 30% rebate. But obviously, ladies and gentlemen, you know, a lot of people stay on agricultural land, but they do a little bit of farming for themselves. You know, they plant their own vegetables and they use it for themselves. That is not a farming undertaking. As long as those products are sort of sold to the public, then you would classify as a farming undertaking. Under life policy, do you insert the amount paid out to the beneficiary? Yeah, so remember, if you had a beneficiary, that would be not for your liquidation account, but for your estate duty account. And yes, you would insert the amount paid out to your beneficiary in such a scenario. 100% correct. How does business life policies fit into estate duty calculation? So I would assume when you're asking how does business life policies, what springs to mind is perhaps like a Keyman's policy. You know, now if you have a Keyman's policy, what we usually see with that is sort of businesses that insure their employees' lives. In other words, if the employee passes away, the business will get such a payout. If you were the owner of that business and you passed away, then that business insurance you took out will actually count as deemed property under your estate duties. Over here, life policies with named beneficiary, any Keyman's policies, you know, as you referred to it over here, business life policies would count as deemed property in estate duty. So that is where it would fit in. Okay, here's another one. Trust for kids and spouse as beneficiaries of life policies and properties considered as a Section 4 allowance or not? Well, I suppose the question would be, is it forming in the trust or not? Is it taken separate from the trust? The moment it is something that already falls under a trust, it is totally excluded from this. But if it is not falling under the trust, then we'd have to include it. So I think that would be the main question over there. Was it taken by the trust or taken by the individual? If by the trust, then it has no bearing over here because the trusts are excluded. Okay, I presume that the executor will calculate the accrual payable. How is this reflected and controlled by the master? Well, I don't know. I wouldn't say that's a safe assumption because accrual can be quite a complicated thing to calculate, especially if you have to consider that you're trying to figure out how much each spouse grew during their marriage. So a lot of times attorneys do not themselves calculate the accrual, and they actually employ the services of a professional to do so for them. For example, an actuary. You could bring an actuary in to come and calculate that. It would probably be a safer way to deal with it. And obviously those accrual calculations must also be kept and provided to the master, just so that the master sees how you got to that figure. I mean, anything that you are plussing or minusing or calculating, at the end of the day, the master must have disclosure thereto. How would you know as executor what policies paid out to the beneficiaries for purposes of including same as deemed property? And what is the executor's obligations in this regard? Okay, well, it's interesting in reality because, part of winding up a deceased estate is not just taking over the actual estate and seeing, what was going on there, but also having conversations with the family members to see, what they know about the deceased individual. Now, usually if there's a life policy that was paying out to a beneficiary, there would have been some form of debit order over on the deceased bank account. Now, remember, the moment you became executor, you had total control over their bank statements and their accounts and so forth. So you would have been able to see that there is a deduction. And any debit orders that are going off, you would have needed to do an inquiry as to where that money is going and for what purpose. And at the same time spoke to the family members of what they are aware of, what the deceased person had, And that's as far as you can go with it. And from there, you should be able to establish, if there was any life policies that paid out. And obviously your duty as executor is to act ethically at all times. If a life policy was paid out to someone, and then you don't go and display that life policy in estate duty as deemed property, whilst fully knowing there was a life policy paid out, if that comes out, or if the master does an investigation into that, or if SARS does an investigation into that, because remember, SARS would know what's happening in that deceased person's life. So they might be aware that there was a life policy, but notice that you haven't included that in estate duty. They would investigate to find out why you as executor have not put it there. I mean, if you haven't put it there because you didn't know about it, I mean, obviously you'll just need to explain that and amend it as such. But if you did know about it, I mean, obviously you're negligent then and you're actually committing fraud to such an extent. So, on the face of it, you might think, how would someone know? But in reality, all of these things are being kept tabs on through all the bank statements that the masters also have, obviously, access to, as well as SARS at the end of the day. So, yeah, but it can happen, and it has happened in the past, where people only discover things at a later stage, when it's too late almost. Just please keep in mind that if you are winding up a deceased estate and something comes to your knowledge thereafter, you need to notify the master's office so that they can look at possibly opening up that estate again, because it might adjust some figures at the end of the day. All right. If there are fixtures on a house like built-in cupboards, does that count towards the value of the furniture of the house? No. So any fixtures made to the house would count as the value towards the immovable property itself. It is only the movables in the home that count as, or that go towards furniture. May you please explain total assets less 30% of farming undertaking? So you are on estate duty, I assume. And if we look at the calculation, property plus deemed property minus allowed deductions minus 3.5 million equals that. 20% of that is estate duty. So if we speak about the farming undertaking, you're talking about property then. So if we recall, we had to calculate what property was and put that figure in here. And we said property was our total assets. That we took straight from our liquidation account. We put that figure in there. From there, we could potentially minus the 30% farming undertaking and the difference in private company shares. That minus that or that, depending if you had that, will give you your property figure. But you obviously asking about this farming undertaking over here. So just to repeat, this is when you pass away, but your immovable property was agricultural land where you were actually doing commercial farming on it. Right? So maybe your immovable property was valued at R1,000,000. That would have been over here then, right? Would have been here. Your farming immovable property would have been here for R1,000,000. Okay? But SARS is saying because it's immovable, because this immovable property is a farming undertaking, in other words, there's commercial farming happening on it, 30% of this R1,000,000, we're not going to tax you on. We'll only tax you on the remainder. Remember, this R1,000,000 already forms part of your total assets, over here. So it forms part of your total assets over there, because we took that from the liquidation account. But if that was a farm and it was valued at R1,000,000, 30% of that we're not going to tax you on. So what's 30% of R1,000,000? That's 300,000 Rand. So we could minus the 300,000 Rand over there. So it's just for that farming undertaking. SARS are saying we'll only tax you on 70% of the value of that farm. The other 30% is tax-free, in other words. That is why we get to minus it from our total assets. All right, so money in an investment account, would this be considered assets under the heading claims in favor? Yes, 100% correct. Any invested money would be collected money, so it will be under claims in favor under assets. That is correct. What if we were married in community of property and no kids? My policy's beneficiary is my spouse and dead in an accident, and there was no will. What will happen to our money left behind? Well, if there was no will, then it means you died intestate, and you'd have to follow the intestate rules. Now, in terms of intestate rules, your spouse and kids are first in line to inherit. But from what I can read here, you're asking, you don't have a spouse or kids as such. So you'll have to go to who's next in line to inherit. Next in line is your parents. If you don't have any parents, next in line is your brothers and sisters. If you don't have any brothers and sisters, next in line is your closest blood relatives like uncles and aunties and so forth. And if you don't have any of that, then it goes to the state. So yeah, in your scenario, if there's no will, it means you die intestate, because remember, this policy would then have had no beneficiary to pay out to, because then it would have just paid into your deceased estate. And if there's no beneficiary, it comes into your deceased estate, you have no will, it means you died intestate, so it will be distributed in terms of the law of intestate succession. Okay. Life policy pays out to a beneficiary, but monthly premiums were paid by someone else, not the deceased. Is this still deemed property? Yes, unfortunately, it is still deemed property. So the basis for deemed property is who was the person who had the life policy. In other words, over whose life was this policy held. And if the life policy was over the life of the deceased, it doesn't matter who was paying those premiums. It is still regarded as the deceased asset or property for purposes of estate duty. Okay, here's another one. If a life policy was ceded to a bank, at date of death, there is still an outstanding bond over immovable property, but the policy will cover the outstanding loan. How will this reflect in the L&D account? Do you still mention the outstanding loan at the bank as a liability? How do you deal with the fact that the policy settled the loan? Okay, so nice question actually, because this will actually take our knowledge on policies a bit further. So, on top of what we've already looked at regarding life policies, another note we can make is any life policies that are ceded to the bank are regarded as the life policy of that individual. So if you pass away and you had a life policy that was ceded to the bank, or any type of policy that was ceded to the bank, it is still your life policy. So it must be included in the liquidation account, right? The reason being is, what was the purpose of that policy? The purpose was, if you pass away, this money is used to obviously pay the remainder of your bond. Okay. So they are saying it is still money that is being used to pay your bond. So it is your asset ultimately. And remember the full disclosure clause. So even if you have a life policy that we are going to use to cover our bond in this type of scenario that you have given, you would need to list that life policy out as a claim in favor in your liquidation account under assets, and then still disclose your liability at the bond by your creditors, by your liabilities. So in other words, your life policy, which was ceded to the bank, will be listed as an asset by claims in favor, and then your outstanding amount owing on the bond will be listed as a creditor under liabilities. So the one will cancel the other one out. So you can't just let that pay your bond and then leave about it. You still need to have full disclosure, because the value of that life policy is still an asset in the deceased estate. I hope that answers your question over there. Just give me a moment, ladies and gentlemen. I'm just working through these questions. Okay, in a RAF claim which has not yet been settled, where will this be reflected? Okay, so this is sometimes also the challenges we face in winding up a deceased estate. Ideally, I think I mentioned to you last week, you want to be done with step 4. In other words, you want to have been done drafting your L&D account within 6 months. But sometimes, we come across deceased estates that are taking like 5 years to wind up. I know of some, the longest one I know is 9 years. And that's because there's a lot of hiccups and challenges along the way. We can't simply just wind up this deceased estate. Just one moment, ladies and gents. Something's happened here. Okay, there, I've got it back. Okay, so in a typical scenario where there's a RAF claim which has not been settled but still needs to pay out, so I would assume this is perhaps money that RAF owes the deceased person. What you would do as executor is you would need to wait for that money to come in, because that money is going to come into the deceased estate, and that money is obviously going to be money that's going to go to the heirs and legatees or marriage or to the creditors, whoever it's going to go to. So you wouldn't be able to wind up your deceased estate. You'd have to wait for that claim to first be settled and reflect, and when that money comes in, that payment from the RAF that's going to come into the deceased estate, you would put under claims in favor, okay? Because that'll be collected, that money, under claims in favor in your liquidation account under assets. Can attorneys agree to a 3.5% fee for doing everything on behalf of the executor? Is this seen as a part of the executor's fee or admin fee? When that is done, then that will be the executor's fees. So you'll need to have a written contract with that person that you are acting as executor, and that executor themselves cannot then also go and claim 3.5%. So you can't have you claiming 3.5% plus the actual executor, you're the one that did all the work. You should get the 3.5%. The executor will then not be entitled to a fee as such. So you'll often see executors would approach attorneys and say, listen, can you help us wind up the deceased estate? And they would reach an agreement with the attorney to share in the 3.5%. Maybe they'll give the attorney 2.5% and they'll take 1% themselves, which is fine. You may enter into such agreements with your clientele, but you can't have two separate people each claiming a 3.5% executor fee. Okay, if life policy has no named beneficiaries, will it be a plus or minus in estate duty? So you would have noted from estate duty we did not include any life policies that had no named beneficiaries. And the reason being, if we go to our assets, we said any life policies with no beneficiaries falls as an asset in our liquidation account. It gets paid into the deceased estate. So the moment it's an asset in our liquidation account, that figure is there, meaning it forms part of our total assets. So when we do estate duty by property total assets, that figure already forms part of the total assets. It is only the life policies that had a named beneficiary that did not form part of our liquidation account. That is why we make mention of them for estate duty purposes, because those with no named beneficiary came into our deceased estate and was already an asset. So it already forms part of estate duty over here under your total assets. Here's an interesting question. Movable property. For the purpose of gaining a valuation, classic collector's items will have a collector's value and a market value. Example, 1950 car from a dealership, the value will be a lot less than a collector's value. How do you deal with this? Well, you know, I personally haven't had a deceased estate where I've had to deal with something like that. So I don't, necessarily want to comment on something that I myself haven't done. So what I can tell you is that I have dealt with a matter like that in court regarding a civil action. And in court, the court was only interested in the value of that vehicle, not in terms of from a collector's item perspective what it was worth. So, like I say, from my knowledge of dealing with things like this, from the court we dealt with, they were quite hard on the fact that it's not about collector's item value or sentimental value or whatever the case may be. It's the actual value of that vehicle as valued by a registered company that can do things like that. So the collector's item value didn't have much reference, or the court didn't consider it in our particular case. Again, I didn't deal with this regarding a deceased estate, but I did it regarding a civil action. So from what I've dealt with, I don't know that collector's item is going to have much value. But I stand to be corrected on that. As mentioned, I haven't dealt with a deceased estate that had a collector's item like that. All right. Ladies and gentlemen, there is a couple more questions, which I will then factor into tomorrow night's questions as well. And please, ladies and gentlemen, I think what's important is, when we are done, not tomorrow night, tomorrow during the day, when we are done, there's a chance I might not have got to everyone's questions. Please mail those questions through, and when I get a gap, I'll answer all of you. All right. But as far as today goes, I noted it is 1:30, so that ends our session. We'll be back tomorrow at 11 o'clock. See you all then.